At the moment, Saudi Arabia is insanely rich. It controls over 15% of the world's oil supply, or enough to give every citizen around $300,000 each. But an asset which once made the country unbreakable could be turning into their biggest flaw. In 2025, over half of the country's entire economy and around 80% of their government revenue came from the oil industry alone. Even industries that you think were independent are in reality deeply tied to oil. Take agriculture. Saudi Arabia once spent billions trying to grow wheat in the desert, and at one point it even became the 6th largest exporter in the world. But this entire industry was never truly independent, relying instead on the government buying up farmers' stock for about 5 times what it was actually worth, just to keep them in business. In total, that program cost $85 billion, and in 2016 was quietly shut down. Since they discovered oil nearly 100 years ago, it's been desperately trying to diversify its economy, each way seemingly weirder than the next. Spending billions of dollars building a 150-kilometer futuristic line city, a ski resort in the desert, and this, a turtle-shaped floating city, also in the middle of nowhere. While this wasn't exactly rational economic wisdom, people thought it was part of a bigger, grander plan. But as time has gone on, more details have begun to emerge, and nobody knows where the money is actually going to come from. The line, originally planned to stretch 150 kilometers, has already been scaled back to just 2.5, with the total cost of these projects now estimated to be over $1.5 trillion, 3 times the original budget. So far, the country has been using its reserves to plug the gap, but those are being drained, from 750 billion 10 years ago, now to 400. And at this rate, the country would run out of reserves by 2036. Investors are starting to notice. Insurance against a Saudi default has spiked, rating agencies are issuing warnings, and borrowing costs are climbing fast. People are starting to wonder, could one of the richest countries in the world end up going bankrupt? To truly understand what's going on in Saudi Arabia, we need to go back about 50 years, to a time when the country was basically unrecognizable. In today's money, the average worker was earning only around $6,000 a year, less than half the global average. But in the 1970s, something happened which would totally transform the country: the oil crisis. In 1973, Egypt and Syria led a surprise attack on Israel, and the ensuing Yom Kippur War caused regional chaos, and as the fighting escalated, the US stepped in to support Israel. In retaliation to these attacks, Arab members of OPEC, a cartel of oil-producing nations, used their most powerful weapon of all, imposing an embargo on the US and its allies, punishing them for supporting Israel. Almost overnight, the price of oil quadrupled, triggering an economic shock across the world. Most developed nations had built their prosperity off cheap energy, especially from these countries, and suddenly that foundation was gone. Inflation across the Western world soared, even reaching 25% in the UK. But while most of the world was reeling from the crisis, Saudi Arabia was making more money than they knew what to do with. In less than a decade, their annual oil revenues jumped from around $4 billion to over $100 billion, and in just 10 years, average incomes in the country doubled. Almost overnight, desert towns transformed into modern cities. Steel skyscrapers began to dot skylines that just a decade earlier had been covered by low-rise mud brick buildings. But while the country had become rich on paper, it was a very different kind of economic growth to what had happened in the US, Europe, or East Asia. Typically, when a country becomes rich, it does so by transitioning from an agricultural to manufacturing and then to services. This has been the blueprint for most Western nations, and has meant the wealth that has been created tends to be spread out more evenly across society, with spending flowing through every area of the economy. Obviously, this still has limitations, as we are now seeing in the Western world, but in the past it worked. Saudi Arabia's economic growth, on the other hand, was different. Because it was almost entirely fueled by oil, the country never really bothered to develop any other industries. The types of things that typically make up a modern economy, a diversified private sector, strong export manufacturing, and tech innovation, simply didn't need to exist. Almost 70% of the country is employed by the government, of which about 75% of the budget comes from oil money. For context, in the US, just 15% of people work for the government. This total reliance on oil created a political system where power is effectively held by one family alone. The Saudi royal family has a net worth of $1.4 trillion, around 50 times that of the British. But more importantly, they have total control over the country's economic system. With this kind of power, there's pretty much no pressure to build a broad-based economy that serves the wider population, because the government's survival doesn't depend on the popular support. Despite being atrocious for human rights, by not facing elections, the country was able to invest tens of billions into oil extraction infrastructure in the 80s, helping them rapidly increase their production capacity from 3 million to 10 million barrels per day in just a couple of decades. But relying on an autocratic system that depends almost entirely on one industry also carries serious risks. If the price of oil drops, it's not just the royal family that suffers, the entire system starts to fall apart. During the 2014 price crash, oil revenues were cut in half practically overnight. This forced the government to borrow huge amounts of money to cover its expenses. The country's budget deficit soared to 15% of GDP, a record high, and with almost no private industry to fall back on, there was no real safety net, so if average incomes fell by nearly 20% in just the span of a few months. Eventually, oil prices rebounded, and the economy began to recover. But that crisis revealed something deeper: how fragile the entire system of one of the Middle East's biggest countries really was. If the oil money stops flowing in, the entire system falls apart, and this might already be starting to happen. Global oil sales are set to peak sometime before 2030. Major trading partners like the EU and US are already investing hundreds of billions into clean energy sources or their own domestic production. Even China, the world's largest oil importer, committed to reaching net zero by 2060. Of course, the Saudi royal family is well aware of this. They knew that for the country's economy to survive, it would need to make a radical transition away from its current model. And in 2016, that's exactly what happened. Vision 2030 was supposed to be one of the boldest economic reform plans in history, a sweeping attempt to transform the kingdom from an oil-dependent autocracy into a modern economy. The plan was simple: use today's oil wealth to invest massively into new industries, building an entirely new economy from the ground up. Saudi Arabia promised to invest $400 billion in the project over just the first decade, targeting key sectors like tourism, technology, and finance. The aim was to reduce oil's share of GDP to just 30% of the economy, and quadruple non-oil government revenues in the process. In short, the kingdom wanted to reinvest itself as a global hub for innovation and investment, creating a diverse, self-sustaining economy for the future. The most famous of these initiatives was NEOM, a megacity in the desert, featuring flying taxi networks, AI-powered public services, zero-carbon energy systems powered by entirely solar and wind. But the project was a massive gamble. If oil prices stayed high, the Saudi government could use the cash to transform the country into a modern economy. But if they didn't, the government simply wouldn't be able to afford the massive spending the project required. Official estimates show that to sustainably fund Vision 2030, oil prices would need to stay around £90 per barrel. And if they were to fall much below that, it would cripple the country's finances. Then Russia invaded Ukraine, and that's exactly what happened. In just a couple months, prices dropped by more than 25%, falling to just $76 a barrel. For the Saudi government, this was a total disaster. Aramco, the government-run oil company, saw its profits fall by 25%, costing the country over $90 billion a year. Money that was supposed to be invested into mega projects simply wasn't there, leaving the government with only one option: borrowing. In 2024, the country's budget deficit rose to 2.3% of GDP, the fastest rate seen in decades. And by 2030, Saudi Arabia's debt to GDP ratio is expected to reach around 43%, nearly 20 times higher than the 2.2% in 2010. You might think that doesn't sound bad at all. After all, the US has a debt to GDP ratio of 124%, far higher than Saudi Arabia's. But there is a crucial difference. The US has deep financial markets, political stability, and a diverse economy that can absorb shocks. Saudi Arabia, by contrast, relies entirely on oil, so when prices fall, its entire fiscal position suddenly falls apart. This creates a real risk of a debt crisis. If investors lose confidence in the country's ability to repay its debts, they may sell their loans, causing borrowing costs to skyrocket. and overnight the billions of debt that the country took on to pay for the mega projects would become much more expensive, forcing the government to cut spending just to cover existing debts, potentially triggering a downward spiral, even pushing the economy into recession. And we might be on the brink of that today. Earlier this year, interest on the Saudi credit default swaps, an indicator of investors' confidence, spiked to the highest level seen since COVID. And at the same time, reports have surfaced of growing concerns with financial markets and among international rating agencies about their high levels of debt. If interest rates on government debt were to rise by just a few percentage points, it could end up costing the government an extra $10 billion every year, around 3% of the country's GDP. That kind of financial pressure makes it even more important to examine where all this borrowed money is going. Spending hundreds of billions on what is essentially the country's credit card is risky in any circumstance. But if that money is going towards productive assets that drive long-term growth, then it can sometimes pay off. In Saudi Arabia's case though, Vision 2030 is starting to look less like a smart investment and more like an overpriced gamble. Many of its flagship projects are reportedly behind schedule, massively over budget, or plagued by internal dysfunction. Originally projected at $500 billion, NEOM's cost is now estimated in the trillions, and internal reviews suggest that just 1% will be completed by 2030. One of the most iconic features, the Line City, has been downsized from a 170-kilometer vision to a mere 2.4 for just 300,000 residents. But despite this failure, the government keeps doubling down. A whole set of mega projects, from futuristic ski resorts in Trojena to theme parks and Red Sea resorts, are still underway or announced. It's a puzzling approach, especially given the stated goal of diversifying the economy. After all, there are proven strategies of reaching this target. The one obvious example to point to is Norway. In the 1960s, it discovered it was sitting on hundreds of billions of dollars worth of oil in the North Sea. But rather than splurging the money on flashy investments and tax cuts for the wealthiest, it created the Norwegian Sovereign Wealth Fund. Today, it's worth over $1.6 trillion, making it the largest sovereign wealth fund in the world. The fund owns 1.5% of all global equities, and the interest generated covers around 25% of the government budget every year. That means the country can afford to do things like offer universal healthcare and free higher education. Today, Norway is one of the richest and happiest countries in the world, regularly ranking at the top of global quality of life indexes. So why doesn't Saudi Arabia just copy what they did? It's not like they don't have the money. Saudi oil reserves are estimated to be 10 times the size of Norway's. The reason is simple. Look at where the power actually lies in the system. Saudi Arabian political institutions are unlike almost any other country. Government is an absolute monarchy centered around the royal family, with power almost entirely concentrated in the hands of the king. All of this means that the forces that influence political decision-making are entirely internal to the system. Because there is never any real threat of the crown prince losing power, the government simply doesn't need to think about the interests of the average person. And that's exactly why something as crazy as Project 2030 was ever able to happen. Because at the end of the day, the Saudi government is more focused on chasing international prestige than pursuing meaningful economic reform. So even as the global demand for oil declines, billions continue to be poured into flashy, high-risk megaprojects that offer little in real return. The truth is that the future of their country hangs in a delicate balance. If the kingdom manages to successfully pull off its ambitious vision for the future, it could thrive in a post-oil world. The royal family certainly has the money to do so. But at the heart of the country is a deeply dysfunctional political system, and only time will tell whether the system is capable of delivering real, lasting change. Because without transparency, accountability, and genuine incentives to serve the public good, even the best funded plans risk collapsing under their own weight. Another area Saudi Arabia is also investing heavily in is crypto, although this may be one of their smarter investments. In May 2025, the Saudi Central Bank disclosed a purchase of up to $60 billion worth of cryptocurrency assets. And in fact, crypto has been on a real bull run recently, and this stock has been outperforming Bitcoin for years. Our top crypto idea graduated to the NASDAQ, and it's the sponsor of today's video, DeFi Technologies, ticker DEFT. When Tom Lee shared the post that hedge fund manager Eric Jackson had shared on his X account about DeFi Technologies in November last year, the company had still not graduated to the NASDAQ, and its share price was $2.28 compared to $3.25 today in mid-July. In the last few years, DeFi's performance against Bitcoin has been massive. Its 1-year performance was 76% better, and over 3 years this has been 339% better. But how does DeFi Technologies achieve this? Their business covers a blanket of the entire ecosystem, and its growth avenues are seemingly without any visible constraints that I can see right now, and the proof is in the pudding, as DeFi Technologies announced record quarterly results, and its trailing PE ratio is only 9. DeFi Tech is a profitable business that grows globally with the continuous adoption of decentralized finance and crypto assets. The crown jewel business is, in my personal opinion, one of the most predictable and recurring forms of asset management models around today. The company's subsidiary, Valor, creates and issues ETPs, exchange-traded products, for the cryptocurrency sector. As this image shows, at the end of May 2025, Valor had around $800 million under management, and it monetizes that sum in a way that other asset managers could only dream about. Not to mention that the 47th president of the US even named a crypto czar David Sachs, as Trump announced he was going all in on crypto and blockchain, saying that the US will become a Bitcoin superpower. DeFi's subsidiary Valor offers 75 exchange-traded products, covering the full spectrum of the crypto market, and this is the model that makes them so profitable. The ability to provide institutions who are barred by their forming documents and prospectus from owning cryptocurrencies outright, but are 100% eligible to own ETPs. Even after reporting record revenues this past quarter, and even after surging more than 250% in the past year, the company still trades at a trailing PE ratio of under 10. By now, you can see that DeFi Technologies is a great crypto idea, and it's outperformed Bitcoin itself in the past 5 years. DeFi Tech also has a digital asset treasury where its total value stood at approximately $48.4 million. An incredible business, and the numbers speak louder than anything else. DeFi Technologies is one of only 3 profitable public crypto companies, and DeFi themselves have also been buying back millions of dollars of their own company's shares. Check out DeFi Technologies, ticker symbol DEFT, and visit defi.tech.